Hey guys, election time is coming up on us pretty quickly here, and I've had a lot of people been reaching out to me about concerns about what the election may bring. But before we get going on that, I do have a free report for you guys titled, Will the Election Rattle My Retirement? Now this is an 8-page report that gives you an idea of how elections in years past has affected the market and what kind of corrections or volatility swings we've seen and how those have played out over time. It also gives an insight on how markets perform under one party versus another. It doesn't matter if one party controls the Senate and the House or not. So there's a lot of different insights in this guide. Feel free to check it out. So for this video, I'm just going to call it like I see it. I'm not going to pick any sides. So please do not comment anything political or start any kind of debates, because I will be removing them from the channel. If we look back until about 1980, the average market correction is about 14%. So elections can definitely play a role in how much volatility we see in the marketplace. Sometimes we see the market turn sour shortly after an election, and sometimes it goes positive. So it's going to be a free-form swing, and it's really anybody's guess on what it's going to do. Now, the market has been recovering fairly steadily since our close call back in March, where we saw the fastest drop in U.S. history, followed by the fastest recovery. And just to put into perspective how fast this was, the last 6 major market crashes took a little over 2,100 days for the market to recover. The crash from COVID-19 took 117 days. So it happened very, very quickly. So we definitely got lucky there. If that crash scares you at all and you were worried about if you had enough to retire on, then now would probably be the best time to move into something safer so you don't have to relive that experience again should the markets turn sour. Whether that's triggered by election or something that comes up in 2021 or beyond, you just want to be prepared for it. And in the words of Warren Buffett, it's insane to risk what you have for something you don't need. So in other words, if you have what you need today to live a happy and comfortable retirement, then you should not be taking on more and more risk or just trying to earn an extra 5, 10, or 15% on top of what you've already made. We've been in the longest bull run in market history, so at some point it's time to start taking a step back, especially if you're getting closer to retirement. If you're in that 10-year window of retiring, that's 10 years before retirement and 10 years after retirement, taking the least amount of risk is probably one of the smartest things you can do at this time. Because if you were to suffer another big market correction and it doesn't recover like it did this year, it could very well take a very long time for it to recover, and you may not have the same retirement you once did. It's also important to remember that market recoveries aren't always a given thing. Yes, it's happened in the United States so far, but for a period of time, we've seen zero market returns, and it's taken nearly a decade to get back to market highs. Just look back into the 2000s, that's what we refer to as the lost decade. The market crashed in the year 2000, it almost recovered in 2008, and then it crashed again, and it took until 2013 before markets were back to even. That's 13 years of a zero return. So that could definitely happen again, and it's crazy to think that that won't happen here. Let's just take a look at the stock market in Japan. They peaked in their market in the 1980s, and they've had a crash, and they've been down ever since. 30 plus years of a down market. Look over in Europe, they've been down for over 20 years. So to think that that won't happen in the United States, given the fact that we've been on this market tear, and the gains just keep getting bigger every year, and that graph just gets steeper and steeper and steeper, that's typically a sign of a market blow-off coming, and it's very similar to the run-up we've seen in the late 90s that led to the dot-com bubble bursting. So obviously I don't have a crystal ball, but that's just kind of what I'm seeing out there. A lot of the reasons why the market is still up is due to a couple of artificial factors that are affecting the market or just propping it up. Back in 2018, we had that slight dip, and it got propped up by stock buybacks. And those buybacks is what led to a lot of companies having little to no cash because they kept buying their stocks back since that time. So in 2020, when we had the COVID-19 crash and a lot of businesses were shut down, many of them needed funds from the government because they had no cash on hand. They spent it all on their own stocks to increase the price so their executives could get higher payouts. In 2020, we had a lot of federal funding that helped dig us out of that hole. To put it into perspective, the federal budget on spending each year is about $3.6 trillion, and we spent $2.8 trillion in stimulus money alone that was unaccounted for in the budget. So how is that going to affect the economy in the future? That's something that we're going to see play out over the years, and how are we going to pay for this national debt? Now that $2.8 trillion of debt that the government has taken on unaccounted for is still going to grow with interest, and it's projected to reach over $5 trillion. So at some point in the future, we're going to have to figure out how we're going to pay for this. And the only way that governments can get income to pay off debt is through taxes. So taxes are something that are probably going to go up in the near future. It's already written to go up in 2025. So should the current president retain his office, then we should see tax rates stay the same for the next few years. If we have a change in leadership, then he could and probably will change taxes before that 2025 deadline. So in closing, I really don't think it's going to matter who takes office next. Yes, there's going to be some volatility either way, but it's not going to be the next catalyst, in my opinion, on what's going to trigger the next market downturn or recession. What I'm really concerned about is the market trend we've been on. How we can have this giant crash followed by a very quick recovery, have millions unemployed, and the market's still up, and companies are still turning out record profits. And the other concern is the amount of debt the country's been taking on. At this point, interest alone on the national debt's over 10% of the federal budget. And then for us to just print $2.8 trillion out of thin air unaccounted for is definitely going to have some negative impacts in the future. And if the government's not able to bring in enough tax revenue to cover these expenses, or at least cover the interest on the national debt, then we run the chance of defaulting on the national debt. And that's not going to be a good situation for anybody. And you can bet that the government's going to do everything in their power to make sure that doesn't happen. So if you think taxes aren't going to go up anytime soon, you may want to rethink it over. And that's exactly why I do things like the Tax-Free Masterclass, to help you guys be prepared and start building a tax-free retirement so you don't have to wait and find out to see what taxes are going to do in the future, or how high they can go. Make sure you also grab a copy of that free election guide, and I'll see you guys next week. And remember that your future depends on what you do today.